Let's just proceed. So just to recap, we will start with problem 1-2 from the very beginning. As I have already emphasized before class, most of the problems that we will encounter for cash and cash equivalents would have a common theme wherein the task for us would be to simply identify items that are to be included in our cash and cash equivalents. And once we have correctly identified the items that will form part of our cash and cash equivalents, all we have to do would be to add the corresponding values that pertain to the items to be included in the cash and cash equivalents account. Although there are some problems wherein we will have to determine the correct or the adjusted amount to be reported, but you would also notice that most of the information that will require an adjustment will only require either an addition or a subtraction, or sometimes even the additional information will have to be simply ignored in arriving at the correct amount for the item to be included in our cash and cash equivalents. So beginning now on problem 1-2, first we have the cash on hand. Obviously, this will form part of our cash and cash equivalents. Petty cash fund, also part of our cash and cash equivalents. Security bank current account, uh, it being a current account, the withdrawal from this account is almost unrestricted. The balance there is uh, accessible on demand. BDO current account overdraft, as what we have established before, should not be part of our uh, cash and cash equivalents. Overdrafts or over of our total cash and cash equivalents. As what we have discussed before, overdrafts are to be presented as a separate current liability. If you have an overdraft, that only means that you have an outstanding obligation to the bank, and it is to be reported as a liability. Okay, but again, remember that there is also an exemption. Okay, the most common exemption would be that if you have another bank account with the same bank and that bank account has a positive balance. The BPI time deposit 90 days for land acquisition, regardless of the term of the time deposit, the BPI time deposit will not be part of our cash and cash equivalents because it is intended for a non-current asset. It is intended for a long-term asset. Okay, land is definitely going to be classified as a non-current asset. So following our matching rule, we match the investment or the cash fund with its intended use, with its related asset or liability. If the related asset is a long-term asset, therefore the fund will also be treated as a uh, long-term fund or a long-term investment. So in this case, the BPI time deposit will not be included. Sinking fund for bond payable due December 31, 2023. This is one of the things I want to emphasize. Uh, it's not always that if it is for a bond payable, the fund will automatically be treated as being set aside for a long-term use. You have to determine the current classification. You have to determine the updated classification of the bond payable. Although generally, in most cases, your bonds would be for a long-term period, but understand that it is possible for a long-term liability to eventually become a current liability once it reaches a point wherein it is just at most 12 months away from its maturity, which is the case for the bonds payable here. The bonds payable here is due on December 31, 2023, which is just within 1 year from the reporting date. So even though these bond payable may have been a long-term liability before, but as of December 31, 2022, this bond payable is already a current liability because it is just due within 12 months from our reporting date. And the bond payable being a current liability, then that would mean that the sinking fund will also be classified as a current asset. And since it is a cash fund, it will not simply just be part of your other current assets, it will be part of your cash and cash equivalents. Okay. So two things to take away from the last item given here. Please do not think that sinking funds are always not part of your cash and cash equivalents. And please do not think that bonds payable are always for long-term period, or that bonds payable are always non-current. Always check. Always check the remaining time from its maturity. Okay. So basically, we have identified 4 items here. Okay. But the problem is we're given with 2 additional information which may or may not have an effect or impact on the figures given to us in relation to the 4 items we have identified that will form part of our cash and cash equivalents. So first here is the cash on hand included a customer post-dated check of 150,000 and postal money order of 50,000. First, we will deal with the customer post-dated check. Since this is coming from our customer, we are now the one in possession. We are the one being paid with this check. The problem is the check is post-dated, and we do not consider a post-dated check as an equivalent of cash because it cannot be encashed yet. But the problem here is that we have already included it in the balance of our cash on hand. That means that the 1 million balance of your cash on hand, given there as the first figure in the problem, the 1 million there includes a post-dated check. Okay, although we have established before that it's fine for our balances to include amounts represented by a check, but it must be checks that are already that can already be encashed. But since the check here is post-dated check, it cannot be encashed yet, so therefore it will not be treated as an equivalent of our money, so therefore should not be part of our cash on hand. Okay, it should not be included, but it was included, so the correction here is to deduct the 150,000 from the 1 million. Next is the postal money order. This is just a different form of a bill of exchange, which is still treated as an equivalent of money. So no adjustment for the 50,000. Second additional information here is your is as regards the petty cash fund. Okay, based on our records, the petty cash fund is supposed to have a balance of 50,000. But after looking into the exact contents of the petty cash fund, we have realized that in the petty cash fund, there are unreplenished petty cash vouchers for 10,000 and an employee check for 5,000 dated January 31, 2023. Okay, so as regards the petty cash vouchers class, this represents expenses or items that were paid out of the petty cash fund, meaning part of our petty cash fund was already utilized to pay off these expenses amounting to 10,000. Since a portion of our petty cash fund was used to pay off expenses, then definitely it's wrong for us to say that the petty cash fund is still at 50,000. Because again, there are unreplenished items, or there are items representing unreplenished disbursements. It would have been a different scenario had these items been replenished, because that would mean that the expenses, the amounts that were used to pay off the expenses were just replaced with a different set of money. So it would have been correct for us to say that the petty cash fund is still untouched. But here, clearly, the petty cash fund was already partly used, so it will be incorrect for us to say that the petty cash fund is still at 50,000. Now we have an employee check here for 5,000. This can be interpreted class as a reimbursement or a payment by the check who perhaps have used a portion of the petty cash fund. Okay, ordinarily that would have been fine, but the problem is the check is dated January 31, 2023. So definitely this should still be treated as a receivable. By December 31, 2022, the 5,000 peso check here, if indeed it is to be treated as a repayment to an amount taken from the petty cash fund, the check can cannot be treated as good as cash because it is considered also a post-dated check. So all in all, there is 15,000 pesos that is included in our petty cash fund that no longer represents actual cash. So that being the case, it would be wrong for us to report petty cash fund 50,000 because the actual remaining cash in our petty cash fund would only be 35,000. 35,000 is your 50,000 minus 10,000 and 5,000. And there being no additional information here, then that would mean the other items would be reported as is. So cash on hand would be 1 million minus 150,000. We will have 850,000. Petty cash fund would be 35,000. I would greatly appreciate if you'd be able to help me with the totals here. 850,000 cash on hand, petty cash fund 35,000, security bank current account 2 million. Ignore the BDO current account, exclude the BPI time deposit, but include the sinking fund amounting to 2,500,000. So 850 plus 35 plus 2 million plus 2,500,000. How much would that be, class?
5,385,000, sir.
So all we have to do is to add everything. If we have already the correct figures, then all you have to do is to add. And based on your computation, it should be 5,385,000, and that would be the answer. Okay, let's proceed to problem 1-3. Okay, big difference, class, big distinction. In the previous problems or in our previous discussion, the question there was to compute for total cash and cash equivalents. But here, take note that the question is only asking for total cash. So that means we are not going to include cash equivalents. We are not going to include the short-term highly liquid investments that qualify as cash equivalent. Okay. So first, the same theme. We're given a listing. We are just going to identify whether they will be included in our in our cash account. And next is for us to determine whether the amounts appearing in our records are already the updated or the correct amounts. Okay. We have here cash on hand 1 million, but the problem states that the 1 million balance include an NSF customer check amounting to 100,000. An NSF check stands for no sufficient fund, meaning the check is not funded, meaning if the check, when the check was presented for payment, it cannot be in cash because the account is not funded. Now again, we've established before there's nothing wrong if our cash balance includes amounts that are represented by a check, so long as those are checks that are already good as cash. But of course, an NSF check is a check that cannot be encashed, and it's a big no-no for us if the check loses its ability of being encashed. Okay, so that means the amount represented by the check should not form part of our cash balance. But the problem is it was included in the 1 million balance. Okay, so the correct thing here to do would be to exclude the 100,000. So the 100,000 here should be deducted from the 1 million. Okay, next, petty cash fund, 50,000. But we know that the petty cash fund will form part of our cash, being a cash fund that is set aside for current use. Okay, but we'll have to determine, we will have to check, we will have to look into the petty cash fund if indeed the balance there remains at 50,000, if the balance is still 50,000. Cash in bank, obviously part of our total cash. Okay, first additional information, the petty cash fund consisted of the following items: currency and coins 2,000, employees IOUs 10,000, currency in an envelope marked collections for Christmas party, and then check drawn by Armenia payable to petty cashier. Okay, there are two ways, class, of approaching this problem. There are two ways of determining the correct balance of your petty cash fund. the common approach that students use, class, would be to start with the 50,000 and to deduct the non-cash items that are included in the balance of the petty cash fund. Okay, so normally students would say the currency and coins obviously is part of is still cash. The employees IOUs would represent a receivable, while the currency in envelope marked collections for Christmas party is obviously not for the entity and will have to be reclassified. Okay, so normally students would start with the 50,000, deduct the 10,000 employees IOUs, and deduct the 5,000 collections for Christmas party. Okay, and that's how they will arrive at 35,000. Okay, by the way, a new item that you will have, a new takeaway from this problem would be the treatment for checks that are drawn payable to the petty cash custodian or the petty cashier. Okay, important theory here, since this would be the case for most problems. If you will encounter an information that tells you of a check that is being paid to the petty cash custodian or the petty cashier, then that would actually represent replenishment to the fund, class. So please take note of this one, that if there are checks payable to the petty cashier or the petty cash custodian, that amount would represent replenishment to the fund. That amount will represent additional cash being put into the fund. So the total, so the 33,000 here will actually represent a cash item, because this is a replenishment. This would be a replacement of the amounts that were used out of the fund. Okay, so that's why the correct balance for the petty cash fund here would be 35,000. Okay. Then you would ask, is it always 35,000? In problem 1-2, it was 35,000. In problem 1-3, it is 35,000. Is the balance of the petty cash fund always 35,000? The answer is no. Okay, this is just a coincidence. Okay. Moving on to the second approach, class, okay, which is the preferred approach, which I'd like you to adopt, class, is to simply identify the cash items. Okay, the first approach was to start with the 50,000 and deduct the non-cash items. The second approach, which is my preferred approach, would be for you to simply identify the cash items. And normally it will just come in two forms, class. You will have the currency and coins and bills, and you will have the replenishment to your petty cash fund. And just be careful that the problems will not directly say that the fund was being replenished. It would normally state it as a check being drawn or made payable to the petty cash custodian or the petty cashier. Okay. So if you do that, you identify the cash items. In this problem, currency and coins, this is a cash item, 2,000. The check payment to the petty cashier, 33,000. You add the 2,000 and the 33,000, you would still arrive at 35,000. Okay. Again, I prefer that you use the second approach. Second, asterisk, check recorded and dated December 22, 2002 and delivered to payee on January 5, 2023 in the amount of 200,000. In this transaction, class, we are the payor, okay? And the payment, class, we were the one making the payment, and the payment was already recorded on December 22. So that means the cash in bank appearing in our records of 4 million was already reduced by the check payment recorded in December 22. Our issue now is, was it correct for us to have recorded the 200,000 payment as a payment in 2002? The answer is no, because by the end of 2022, the payment was still undelivered. It remained undelivered. So as far as everyone is concerned, no payment has actually taken place. Because again, payment cannot happen without us delivering the check to the intended payee. But what have we done? We have already recorded the payment, although no actual payment have actually taken place. Okay, so to remedy this one, we will have to add back the 200,000 we have previously deducted from our cash and bank balance on December 22. Okay, so we will have to add back the 200,000. The payment will eventually take effect on January 5, 2023. But again, our concern here is as to the condition of our cash balance as of 2022. As of 2022, our cash in bank will remain, will not be reduced by the 200,000 payment recorded on 2022. Because again, it would be impossible for our actual cash in bank to be reduced by this amount because the check was not delivered to the payee in 2022. It was only delivered to the payee on January 5, 2023. Okay. And then final information here, check recorded December 26, 2022, and dated January 31, 2023, delivered to payee on December 26, 2022. Again, we are the payer here, and we have recorded the payment on December 26, so meaning by December 26, our cash in bank balance in our records was reduced, okay? But the problem is the check was dated January 31. It does not matter that the check was already delivered because even if the check was already in the hands of our payee, the payee could still not encash it. Therefore, our actual cash in bank balance could not have been reduced by this amount because the check only becomes due on January 31, 2023. So as far as 2022 is concerned, this transaction should not affect our cash in bank balance. But what have we done in our records? We have already deducted this from our cash in bank balance. Okay, so what we're going to do here is to add back the 300,000. Okay, so we have already tackled the treatment for all these potential adjustments. Based on everything, cash on hand should be at 900,000. Help me again with the totals here, class. Cash on hand should be 900,000. Petty cash fund should be at 35,000. And then cash in bank should be 4,500,000 after adding back the 200 and 300,000 payments. So this would give us how much?
5,435,000, sir.
That's correct. 5,435,000. Okay. Again, takeaway from this problem would be the treatment of checks drawn to petty cash custodians or petty cashier. Okay. I hope everyone is already clear on the analysis involving undelivered checks, NSF checks, post-dated checks, and post-dated checks issued by us and post-dated checks issued by our customers. Okay. Let's proceed to problem 1-4. So here, always check for the question first. Please. Compute for the total cash and cash equivalents. Okay, so here we are again given with a listing, and our first task would be to identify whether or not these items should be included in our total cash and cash equivalents. Cash on hand, again, obviously part of our cash and cash equivalents. Petty cash fund, the same. Philippine Bank current account, it's a current account, it's accessible, it's essentially unrestricted, so also part of our cash and cash equivalents. Citibank current account number 1, part of our cash and cash equivalents. Citibank current number 2, an overdraft, and normally overdrafts would not be considered in the determination of our total cash and cash equivalents. Okay, normally overdrafts should be presented as a separate current liability. But in this case, class, the 100,000 overdraft here would be included in our computation for our total cash and cash equivalents. It will be included as a deduction to the 4 million balance that we have with current account number 1 with Citibank. Okay, why is the treatment of the overdraft in this problem different from our previous discussion? Because in this case, we have another bank account with Citibank. This is an example of one of the exemptions wherein we are allowed to offset our overdrafts with our other cash balances. Okay. Why did we not offset the overdraft in the previous problem? In problem 1-2, because in problem 1-2, we did not have any other bank account with the bank that with the BDO with BDO which had an overdraft. In this case, we can offset because we have another bank account with Citibank. Okay, essentially just an application of your concept of compensation in your loan obligations and contracts. Asia Bank savings account will be part of our, it being a savings account, it's unrestricted, essentially unrestricted as to use, can be withdrawn anytime, so it will be part of our cash and cash equivalents. Asia Bank time deposit 120 days without knowing as to when it was acquired. We are certain that it should not form part of our cash and cash equivalents because as of the end of the year, it is still 120 days away from its maturity. Okay, let's just go. We have already identified the items that will form part of our cash and cash equivalents. We will just have to determine if the amounts indicated there will already be the correct amounts, whether these amounts are already updated, and should therefore be the amount that will be considered in our computation. Cash on hand included the following items. Customer check for 35,000 returned by bank December 26, 2022 due to insufficient fund, but subsequently redeposited and cleared by the bank on January 10, 2023. So this check came from our customer, and again, we have established that it's fine for our cash balances to include amounts represented by check, okay, so long as they are good checks. But the problem here is that as of 2022, this check in the amount of 35,000 will be considered as an NSF check. And again, NSF check are not good as cash and should therefore not form part of our cash balance. But what did the problem tell us? The problem tells us that these items were included in our cash on hand. Okay, it was included even though it should not be included since the check no longer represents cash. So the 35,000 should be deducted from our 200,000 balance. Okay. I hope everyone sees the 200,000 I am referring to. It's the amount that corresponds to the cash on hand as provided by the, as reported by the entity on December 31, 2022. Okay. Then you would ask, but how should we deal with the fact that it was redeposited and cleared by the bank on January 10, 2023? That's well and good that the customer made good on the payment, okay? But such payment only happened on January 10, 2023. You have to ask yourselves, what's the status or what's the condition as far as the entity is concerned as of the reporting date. So as of December 31, 2022, the check remains unfunded. So again, it will be wrong for us to include this in our cash balance. Okay. And with that, class, I want you to be careful because there are some problems that will tell you that it was deposited on December 5 and it turned out to be not funded and later on deposited and cleared by the bank on December 28, end of the year. So that means by the end of the year, class, it has cleared, it was redeposited and cleared. So it's as if the check is already good, okay? So no need to deduct the NSF check there because by the end of the year, the check eventually cleared. So it's as if the check is, there's no defect on the check, okay? But here, why do we have to deduct the 35,000? Because it only cleared the following year. Okay, be careful of the cutoff. If it was an NSF check before and later on redeposited and ultimately cleared with the bank, if it cleared with the bank within the same year, then no more adjustment needed. It is correctly included in our cash balance. But here in this case, it only cleared with the bank the following year. So as far as 2022 is concerned, the check is still no good and should therefore not form part of our cash balance. Okay, second item relevant to our cash on hand balance. Customer check for 15,000 dated January 10, 2023 received on December 23. Okay. The problem tells us that this was included in our cash on hand balance. So the question you will have to ask yourself is, was it correct for us to have included the 15,000 in our cash on hand balance? And the answer is no, because the check does not represent cash yet, because as of December 31, 2022, it cannot be encashed yet because it is dated January 10, 2023. It can be encashed only on January 10, 2023. So by December 31 of the current year, it is not as good as cash. It will not be treated as an equivalent or a substitute for our money. So the 15,000 here should not form part of our cash balance. But what happened in this case, the 15,000 was already included in our cash on hand balance. So the same with the 35,000, this will have to be deducted from our 200,000 balance. Okay. So total deduction now from our cash on hand is 50,000. So that means the correct balance of our cash on hand would be 150, unless there are other information below that will also affect our cash on hand balance. Okay, proceeding to the next additional information, the second asterisk. The petty cash fund consisted of the following items: the currency and coins, IOUs from officers, and unreplenished petty cash vouchers. Unreplenished petty cash vouchers, class, again represents expenses that were paid out of the fund. Okay, the vouchers here represents or are the evidence of the expenses that were paid out of the petty cash. Now, if we use the first approach, class, wherein you will have to deduct the non-cash items, if you would look at the initial balance of our petty cash fund, it's 20,000. Okay, and then here there's no mention of a replenishment, class. Okay. If you deduct the non-cash items, class, out of the three items here, which are the non-cash items, that would be our IOUs from officers and the unreplenished petty cash vouchers. So if you deduct the 2,000 and the 12,000, you would come up with a balance for our petty cash fund at 6,000. Okay, the problem there is that that answer would be wrong because that fails to take into account that there is actually a cash shortage in our petty cash fund. There is a portion in our petty cash fund that is not accounted for. And how did we know that, class? Because if you add all the items, class, that are found in our petty cash fund, it only totals 19,000. How did we get 19,000? You have the currency and coins 5,000, you have the IOUs 2,000, and the unreplenished petty cash vouchers would be 12,000. And if you add all these three items, you will only have 19,000. And supposedly, everything that remains in the petty cash fund plus everything that was used from the petty cash fund should add up to 20,000. Okay, the cash that remains is only 5,000, and the accounted portion of our petty cash fund amounts only to 14,000. So the 5 plus 14 will only add up to 19,000. So that means there is a 1,000 class that is not accounted for. Okay, and although we will ultimately be asking the petty cash custodian to pay for it, but as far as the actual cash in our petty cash fund is concerned, class, there is only 5,000 there, represented by the currency and coins. Okay, if we will run after our petty cash custodian, then what we have is simply a receivable from our petty cash custodian. We do not have the cash yet. Okay, so if you use the first approach, your answer would have been 20 minus 2 minus 12. You would have gotten 6. If you use the second approach, wherein you will just identify the cash items, and in this case, the only cash item here is your currency and coins, your answer would have been the correct answer of 5,000. Okay, so please be careful. If you insist on using the first approach, always make sure that there is no cash shortage. Okay, always make sure that there is no unaccounted portion of our petty cash fund. Okay, So the correct balance for our petty cash fund here should be 5,000. Next, included among the checks drawn by K Company against the Philippine Bank current account and recorded in December 2022 were the following. Because the information that tells us that these were recorded in 2022 is very important or crucial, because this tells us that this has affected already the balance that is shown here in the problem, which is the 5 million. Okay. First check dated December 23, 2022 and delivered to pay on January 31, 2023. So that means we are the one making the payment and we have already recorded the payment. And if we have already recorded the payment, then that means our cash balance was already reduced. The question now is, was it correct for us to have recorded the payment? Was there payment that actually took place? The answer is no, because the check was only delivered on January 31, 2023. Even though the check was already prepared, since the check was not delivered to the intended payee, no actual payment took place. So that makes the recorded payment wrong. We have recorded a payment even though no actual payment took place, then that will mean that our cash balance will be understated. So to correct this one, we will have to add back the 25,000. Okay. Next, check dated January 30, 2023 and delivered to pay on December 28, 2022. Since we know that this was recorded as a payment in December 2022, we know that this was already treated as a deduction to our cash balance. But was it correct for us to have reduced our cash balance in 2022 for this check payment? The answer is no, because even though it was already delivered, it could not have been charged against our bank account because the check could only be encashed on January 30, 2023. So in 2022, even though it was already recorded as a payment, even though it was already delivered, since it cannot be encashed yet, so that means our cash balance could not be touched by this check. So it was wrong for us to have reduced our cash balance from this transaction. So what we have to do is to again add back the 45,000. Okay, so both items will have to be added back. Okay, so that means our cash in bank balance for Philippine Bank current account should not be 5 million, but 5,070,000. Okay. So cash on hand, as what we have identified earlier, what should be the balance of our cash on hand, class? Was it 200?
150,000, sir.
150. So cash on hand 150, petty cash fund 5,000, and then Philippine Bank current account 5,070,000. Include the 4 million, deduct the 100,000, include the 250,000, exclude the 2 million time deposit, and our total cash should be how much?
9,375,000, sir.
Should be 9,375,000. Okay. We will skip the petty cash fund problems and we'll proceed to what amount cash in checking account will be included. Cash in money market account will also be included since it is for short term. Treasury bill purchased November 1, 2022, maturing January 31, 2023. This will form part of our cash equivalents. This will be treated as a cash equivalent. Time deposit purchased December 1, 2022, maturing on March 31, 2023. The 4 million class should not be included. And this is where students who normally commit mistakes, they will only see the March 31, 2023, and they would say to themselves that it's just 3 months away from the reporting date. So that means this should be considered as a cash equivalent. And that is wrong. Because again, if you recall, our 3-month rule is not simply the remaining maturity, but it is actually the remaining maturity as of the date of acquisition, as of the time it was acquired. Okay, so when you acquired the time deposit, when you purchased the time deposit, it was actually still 4 months away, because when you acquired the time deposit, it was on December 1, and its maturity date is on March 31. So when you acquired it, it was still 4 months away. So that will mean that this will not qualify as a cash equivalent. Okay. But make no mistake, this will still be a current asset. This will still be considered as a short-term investment. But this will not simply, it's just that this will not be considered as a cash equivalent. Okay. I hope this is clear. The 3-month rule should be reckoned from the date of acquisition or the date of purchase. The 3-month rule is not simply the remaining maturity as of the reporting date. It should be the remaining maturity as of the reckon from the date of acquisition or the date of purchase. Our 3-month rule is that states that the remaining maturity should be at most 3 months at the time it was acquired or purchased. Okay, and one potential scenario here is that the problem would say it matures on January 31. Then some students would think it's very close to maturity already, so automatically this should be part of your cash and cash equivalents. That's wrong. You have to inquire when was it acquired, because it would be different if it was acquired January of one of the current year and it matures January 31 of the following year. When you acquired it, it was 13 months away from its maturity. So definitely it will not qualify as a cash equivalent, but definitely a current asset, just not a cash equivalent. So I think we have just 3 items here, the 350, the 750, and the 3,500,000. We will have 4,600,000. Okay. Proceeding with 1-11, the same class, the same task. Simply identify which should form part of your cash and cash equivalent. But in this case, take note, the question is only for cash. Okay. So cash on hand, obviously part of cash. Demand deposit, a form of cash. A certificate of deposit will no longer be part of our cash class because there is already restriction as to its use. You cannot just withdraw it anytime. Post-dated customer check, not even cash, it will be considered as a receivable. Petty cash fund, part of our cash. Traveler check, also good as cash. Manager check, also good as cash, the same as your money order. Okay. So how much would that be? Cash on hand 500, demand deposit 4 million, petty cash fund 50, traveler check 200, manager check 100, money order 150. So 450, 500. Do you have 5 million, class, as your answer for 1-11?
Yes, sir.
Okay, proceeding to 1-12. Let me just quickly get my charger. 1-12, what amount should be reported as cash and cash equivalents? First item, their checking account at Metrobank included, employee post-dated check not included, foreign bank account unrestricted and then in equivalent pesos. That will be included since it is unrestricted. IOU from company president, that will be treated as a form of receivable. NSF customer check, as what we have established before, should not be part of our cash. Petty cash fund, 50,000, but after looking into the petty cash fund, the remaining cash there is no longer 50,000 because a portion of it was already used to pay off certain expenses, evidenced by the expense receipts amounting to 40,000. So if expense receipts were, if we were able to find expense receipts amounting to 40,000, that means only 10,000 remain. Postage stamps will form part of our supplies, not part of cash. Treasury bills will be part of our cash and cash equivalents. Treasury bonds are by their nature long term, so not part of our cash. Value added tax account is a cash fund that is set aside for recurrent use, since you will have to settle your input and output tax monthly and quarterly, so it's for recurrent use. So you have the checking account at Metro Bank, employee foreign bank account, the petty cash fund at 10,000, treasury bills at 1,200,000, and the value added tax account. How much would that be in total, class?
8,210,000, sir.
And that should be our answer. For a while lang, class, let me just tend to something. Okay, continuing our discussion, class, let's proceed to problem 1-13. This would be a different kind of problem now. This will require a different approach. You have here, class, the checkbook balance and the bank statement balance. The checkbook balance is the balance of our checking account as far as our own records are concerned. Then you have your bank statement balance, which would tell you the balance of the same cash in bank account, class, but this is as far as the bank is concerned. So what I am trying to emphasize, class, is that both the checkbook balance and the bank statement balance pertain to the same thing. Okay, they are supposed to tell us the balance of our cash in bank. Okay, it's just that the checkbook balance is maintained by the entity while the bank statement balance is prepared by the bank. Okay, ideally, the checkbook balance and the bank statement balance should show or should have the same balance, because again they represent balance of the same item. Okay, it's just that one is being prepared by the entity and the other is prepared by the bank. But although that is the ideal scenario, it cannot be uh, avoided that there are instances throughout the year that the balance per our records and the balance per the bank's records would be different, especially, but the main culprit there would simply be on the timing of the recognition of the transactions affecting the cash account, the cash in bank account. There may be transactions that we are the first to know that the bank uh, that the bank is still unable to transact. For example, outstanding checks. The moment we issue the check, we will normally record the payment already in our records. Okay, but as far as the bank is concerned, it will only record the reduction to our bank account once the checks are already presented for payment. So it's a matter of timing, class. There is a transaction that we are already aware, but the bank is not yet aware. Conversely, it's possible that there are transactions that it is the bank that is able to record first, while the entity is unable to record it yet. For example, interest on our deposits. Of course, the bank will already increase our cash in bank account for the interest that is earned by our checking account, but we'll only be able to record that amount of interest once we are notified by the bank. Okay, there are some transactions that the bank will be the one to know first. there are some transactions affecting our cash in bank account that it will be the entity that will know first. Because of the timing issue, class, there are instances throughout the year that the checkbook balance will not be the same as the bank statement balance. And that is why part of your record keeping would be to prepare a reconciliation of these items. Okay, but ultimately, the amount that will be reported in our financial statements should be the correct balance. Okay, so the approach for this problem would be to determine what balance we will be using to arrive at the adjusted or correct cash in bank balance. And to answer that, you will have to figure out what balance, whose records will have to be adjusted on the information given in the problem. Okay, we have here a check drawn on source account payable to supplier, dated and recorded on December 31, 2022, but not mailed until January 31, 2023. The records that are affected here, class, is obviously the entity's records and not the bank records. Because as far as the bank is concerned, class, the bank has no knowledge of this transaction because we recorded the payment, but we have only mailed the check on January 31, 2023. So when we receive the check, the bank statement balance on December 31, 2022, obviously it has not taken into account this 500,000. So the 500,000 here should be an adjustment to the checkbook balance because this affects the checkbook balance. Okay, so what happened here? We have already deducted our cash in bank account, even though it should not have been deducted because payment actually took place only on January 31, but we have already recorded it on December 31. We have reduced our checkbook balance even though no payment actually took place. So what we have to do here is to add back the 500,000. Okay. So the answer here would be to add the 500,000 to the 4 million. And then cash in sinking fund. Normally, cash in sinking fund will be for a long-term use. Okay, so the 2 million here will not be included. So our answer here will be simply 4 million plus 500,000. We will have 4,500,000. Okay, and you would ask if that was the case, if the bank was not involved in this 500,000 transaction, why did it report a balance of 5 million? The reason there is that there is a transaction that was already correctly recorded by the entity, but simply was not yet reflected in the records as far as the bank is concerned. But that does not mean that we will have to make an adjustment. It is the bank that should make the adjustment because the entity has correctly recorded the other transaction in our books. I hope you'll get clarity more on this one once we discuss bank reconciliation. Let's proceed to problem 1-14. What total amount should be reported as cash and cash equivalents? On December 31, 2022, West Company had the following cash balances: cash in bank current account, 1,800,000 included. Petty cash fund, all funds were reimbursed at year end. So that means the actual cash that is in our petty cash fund is still 50,000. Time deposit due February 1, 2023. This would be part of our cash and cash equivalents. Saving deposit in bank closed by BSP, 1 million, not included. Then you would ask, aren't we able to get some of our deposits since most deposits are insured? That's correct, but since the bank was already closed, we cannot immediately on demand get this money. We will have to process our claim. So what we actually have here would be a receivable and no longer a cash balance. Okay, so the 1 million here will be transformed into a receivable. Okay, that is if we are able to get a full recovery. But at any rate, this will no longer represent a cash balance. We will be reporting a different receivable out of this item. Cash in bank included 600,000 of compensating balance against short-term borrowing arrangement. The compensating balance is legally restricted as to withdrawal. Since the compensating balance class is legally restricted, our treatment there would be to exclude it from our cash and cash equivalents. So the 600,000 will be deducted from our cash in bank. So our cash in bank that will form part of our cash and cash equivalents will only be 1,200,000. So you will have 1,200,000 plus 50. Then you add the 250. You will have a total of 1,500,000. Is my total correct? That's 1,200,000 plus 300.
Yes, sir.
Yes, sir.
We'll have 1-15. Baloney Company held the following account balances on December 31, 2022. Cash in bank, 2,250,000. Cash on hand, 125. Cash restriction for addition to plant in January 2023, 1,600,000. The cash set aside for acquisition of a plant class, a long-term asset, will not be part of our cash and cash equivalents. Okay. For some reason, some students would still get this wrong because in their thought process, because they would think, oh, the amount is going to be used in January 2023. It's just 1 month away. So that will make this for current use. That's wrong. Again, just match it with its related asset or liability. And since a plant class is a long-term asset, then that would make the cash also a long-term or a non-current asset. Does not matter that it is going to be disbursed the following month. Okay, so this is to be excluded. And just to give you a context, class, why that is the rule or the treatment, class. Think of it this way. In 2022, if you would say that you will classify the 1,600,000 as part of your cash and cash equivalent, then that will give you a very big balance to your cash and cash equivalent. And that will give you a wrong sense of liquidity. It will give a wrong impression that the company is very liquid. Because even though indeed there is a cash of 1,600,000, the 1,600,000 cash is not available for current use. There is already an intended use for the 1,600,000, which is to acquire a long-term asset. Okay, it would be very misleading to look at an entity's financial statements having a cash of 1,600,000, and later on it will just be used to acquire a non-current asset, which severely affects the entity's liquidity. If it is intended for a long-term asset, definitely it cannot be used for any other use. And once it is converted into the long-term asset, then you would realize that the entity is really not that liquid. Okay, so it will help the comparability of the financial statements, class. The following year after the plant is acquired, there will be very little change or movements to our total non-current assets. Because even while it was still a cash, it was already reported as a non-current asset. When the cash was used to buy the long-term asset, then it will still remain as a non-current asset. I hope you get the point. It's wrong to say that you have this amount of cash when in reality, there's no other use for this cash. If I am a shareholder, I would think, oh, the entity has the means to pay for dividends. But in reality, the substantial portion of its cash is already devoted for some other use, which is not available for distribution to shareholders. So if you classify this as a part of your cash and cash equivalents, it would be very misleading. That's why the treatment is to exclude it from your cash and cash equivalents. Cash in bank included 600,000 of compensating balance, which is essentially the same as problem 1-14. However, the compensating balance is not legally restricted. And this is the takeaway you are expected to get from problems 1-14 and 1-15. If the restriction, if the compensating balance is legally restricted, then exclude it from cash and cash equivalents. If the compensating balance is not legally restricted, then it's all right to do nothing, meaning to allow the compensating balance to form part of our cash and cash equivalent. So very simple distinction, class. Legally restricted, exclude or deduct. Not legally restricted, do nothing. Let it remain as part of your cash and cash equivalents. So what we have here is your cash in bank of 2,250,000 and your cash on hand of 125,000. And that will give us a total of 2,375,000. Let me just turn on the lights here. One 16, what amount should be reported as cash and cash equivalents? First item here, petty cash fund 50,000, current account first bank 4 million, current account included. Current account second bank overdraft 250,000 not included, presented separately as a current liability. Money market placement included as a cash equivalent in the amount of 1 million. Time deposit fourth bank 2 million to be determined. A check for 100,000 was drawn against First Bank. Current account dated and recorded December 29, but delivered to pay on January 15, 2023. So payment was already recorded. That means the cash in bank account was already reduced. Now the problem is the reduction to the 2022. The payment only is effective on January 15, 2023. No payment could have taken place in 2022 because the check was never delivered in 2022. But what have we done? We have already deducted the 100,000. And what should we do? We should add back the 100,000 to the first bank current account. The fourth bank time deposit is set aside for land acquisition in early January 2023. Does not matter that it's for early January 2023 since it's set aside for a long-term asset. The time deposit will be reported as a non-current asset. So all in all, we will only have the petty cash fund at 50,000, the current account first bank of 4,100,000, and then the money market placement with the third bank amounting to 1 million. So our answer here should be 5,150,000. I hope you're telling yourselves right now, class, that these problems are essentially very simple. Our difficulties, class, by midterm should not come from cash and cash equivalents. It should be on your loans, which is the topic after our accounts receivables. Problem 1-17. What total amount should be reported as cash and cash equivalents? Undeposited collections, which will basically be treated as our cash on hand, 600,000. Cash in bank, BDO checking account, included 4 million. Undeposited NSF check received from customer dated December 1, 2022. Not included since it is an NSF check. Undeposited check from a customer dated January 15, 2023, 250,000. Not included because as far as 2022 is concerned, it is still not good as cash because it cannot be encashed yet. Cash in bank BDO fund for payroll. Payroll is for current use. You cannot not pay your employees for more than 2 weeks. So definitely this is for a short-term or current use. Cash in bank BDO time deposit 90 days included. Cash in foreign bank restricted, excluded, not included because it is restricted. Cash in bank BDO value-added tax account included because it is again also for a current use. So help me with the total here, class. 600,000, 4 million, 1 million, 2 million, and 450.
8,050,000, sir.
8,050,000. That will be our answer. Problem 1-18. Again, we will just have to analyze, class, the effect of these items on our cash balance. Okay, our records show that our cash in bank balance or our checkbook balance is 5 million. Okay, but we have these items to consider. Check payable to RAL, the entity dated January 2, 2023, in payment of a sale made in December 2022, meaning we are the payee here, we are the one receiving payment, not included in December 31 checkbook balance. Was it correctly not included? The answer is yes. Okay, because even though the sale happened in 2022, okay, the payment was through a post-dated check. So as far as 2022 is concerned, this amount remains as a receivable. Okay, this amount remains as a receivable. But what did we do? This was not included, and as what we mentioned, it is correctly not included. So therefore, do nothing for the 2 million. Okay, do nothing for the 2 million. Check payable to RAL deposited December 15 and included in December 31 checkbook balance but returned by bank on December 30 staff NSF. The check was redeposited on January 2 and cleared on January 9. So that means since this was included in the December 31 checkbook balance, this was included in the 5 million balance. Was it correct for us to have included the NSF check of 500,000? The answer is no, because it is not funded, it is not good as cash. So should this be included? No. Was it included? Yes. So that means it was incorrectly included. So what should we do? Deduct the 500,000 from the 5 million. Okay. Check drawn on RAL's account payable to a vendor dated and recorded in RAL's books on December 31, 2022, but not mailed until January 10, 2023. So basically, we are the payer here, okay, and we recorded the payment on December 31. Okay, but since no actual payment took place because it was only mailed on January 10, 2023, it was wrong for us to have reduced our checkbook balance. So what do? We add back the 300,000. So, and of course, your certificate of time deposit will not be part of your cash. So starting with the 5 million, you deduct the 500,000 and then you add back the 300,000. Our answer here would be 4,800,000. 1-19. What total amount should be reported as cash and cash equivalents? Share investments of 1 million that are very actively traded. Very important theory, class. Very important theory. Investment in stocks, investment in shares, or share investments will not form part of your cash and cash equivalents, no matter how highly liquid they are. Okay, that's what the phrase "very actively traded" is trying to tell you. That it is very highly liquid. Okay, this will not qualify as a cash equivalent, class, because they are not considered short term. In the first place, investment in stocks or investment in shares do not have maturity in the first place. So they never mature, class. Okay? So that's why they will not be considered as a cash equivalent. They will not be considered as a short-term, highly liquid investment. Okay? This will be reported as a current asset, but just not part of your cash equivalents. Government treasury bills of 2 million with a 10-year term, but purchased on December 31 with 2 months to go until maturity. Okay. So again, we do not care about the original maturity, class, in the original term. What we are concerned of is how far away was it from its maturity when it was acquired. So when it was acquired on December 31, class, on December 31, it was just 2 months away. So definitely this will qualify as a cash equivalent. So what is the takeaway from this item, class? It's possible for a long-term investment, class, to be considered as a cash equivalent so long as that it was already at most 3 months away from its maturity when it was acquired. Okay, very important thing to take note of. So that 2 million here will be part of our cash and cash equivalents. Cash of 3,400,000 in the form of coin currency, savings account, and checking account, obviously part of our cash and cash equivalent. Commercial papers of 1,500,000 with term of 9 months, but purchased on December 31 with 3 months to go until maturity. The same explanation for the second asterisk here. So that will mean that the 1,500,000 will be part of our cash and cash equivalents. Okay, the original term again is not material. What is material is that it was acquired at most 3 months away from its maturity. So we will add the 2 million, the 3,400,000, and the 1,500,000. This will give us 6,900,000.